Yo. So in the first two videos, I mentioned ETFs and index funds, two types of funds to invest in. But I didn't explain what they were. So in this video, we just gonna cut to the chase. Then we'll mention a third type of fund, which is a mutual fund. And then, we're just gonna break down the basics and then go from there. I think they all have a place in a person's investment portfolio. It just comes down to your objective, your own personal objective, why you invest, the reason why you want to make money via the stock market and things like that. So let's just cut to the chase. So ETFs, that's just an acronym that stands for Exchange Traded Fund. This is my favorite type of fund. I like index funds too. I'm not really big on mutual funds, but we'll get to that later. But ETFs, this is my favorite type of fund. It trades like a stock. So it's very, very flexible, extremely liquid. And then with trading like a stock, what I mean by that is, so let's say when the market open, and the market's open from 9:30 to 4 Monday through Friday. So when they're open, you buy a stock. We're going to liken it to a stock for this reason. So let's say you buy a Coca-Cola stock. Boom, you buy one share and you decide, I don't really want this stock. And you sell it. Boom. You sold it right then. You don't have to wait till the market close and all this stuff. Everything is instantaneous when it comes to the purchasing of a stock and the selling of a stock. So ETFs, when I say they're flexible, it's the same way. It's a fund that trades like a stock. So ETF, for instance, VOO, which is Vanguard's ETF that tracks the S&P 500, probably the most popular ETF out there, along with SPY. But anyway, let's say you want to get in, you want to invest in the S&P 500. You want to get one share of VOO or VOO. You can purchase it right then, and you'll see that transaction reflected in your taxable account immediately. You'll see it right then. But let's say 5 minutes from now, you know what I'm saying? You're new to this. You're not really stable yet. You ain't gained your footing. So you just in and out of transactions. So 5 minutes later, you decide to yourself, man, I'm not really feeling this. I'm gonna sell this. Well, you can sell it, and you'll see that transaction reflected instantaneously. You get your money back, and that's it. So it trades like a stock. It's flexible, and what I mean by liquid is it's easy to get your money back. It's not like if you invest in real estate, like this physical building, commercial building, you invest in it. Well, you can't just sell it right then, and you can't just buy it right then either. It's gonna take a long time. So physical real estate and even other types of real estate investments like crowdfunding, those things are illiquid because it can take a long time to get your money back. So that's all that means. If you're new to this, like I was not too long ago, the terminology is crazy, man. It's almost like you're speaking another language and you hear people use these terms. So that's why it's good to follow my channel. Now, we just gonna cut to the chase, break it down, because where there's no confusion, you can maximize your investment, your decision making. So with ETFs, the reason why it's called a fund is because it's a basket of securities, aka stocks. It's a bunch of stocks. They can range from, I've seen ETFs range from like 20 something stocks all the way to a few thousand if you're investing in the total stock market. And so that gives a lot of investors, unaccredited investors, or people who are new to investing, it provides a lot of convenience and affordability. Because let's say if you try to go out and invest in 100 different stocks individually, you're trying to buy one share of 100 different stocks. I'm talking about these are brand name companies that's been around a long time, like Walmart, Amazon, Home Depot, Lowe's. You know how much money it's going to take to buy one share of 100 of those stocks? So with an ETF, it takes the complexity of investing in a lot of these different stocks and makes it very simple. So it's like a bucket, and inside of that bucket, you have 100 different items, and the items being stocks. You put your money in, you get a whole bucket. So the affordability of it is what makes it very advantageous for people who are not like professional stock pickers, who don't really know what they're doing. And an entire ETF, one share of an ETF, depending on the type of index it tracks, it can be real cheap. So for instance, I invested in, I got a large cap growth fund, ticker symbol SCHG. That's Charles Schwab's large cap growth fund. And right now it trades for less than $30 per share. So the reason why it's more advantageous, more beneficial than buying 100 of those stocks is because it's budget friendly. So with ETFs, the reason why I prefer them is because you can get in and out of it. You don't have to wait till the market closes as opposed to an index fund, which we're gonna go to next. And it makes investing in a bunch of different stocks a lot more affordable. I can already see I'm gonna have to do a part 2 to this video, because even as I'm talking, I'm thinking of more things I can say, but I don't want to make this video long. You know what I mean? So now we're just gonna jump to the index fund, which is it's very similar to an ETF. So take everything I said about the ETF, with the exception of it being as liquid as an ETF. When I said earlier, ETF, you can buy and sell ETFs. It trades like a stock. You get your money right then. You can buy it right then. If you want to sell it right then, you get your money right back in a few seconds. With an index fund, the only difference is that. So if you buy an index fund, you won't see the transaction reflected until after the market closes. Speaking from experience, I'm tripping. What I notice is I see when I check around about 6 o'clock, I notice that my portfolio will have updated. I don't know if it depends on the brokerage that you use. I'm a Fidelity person, so I don't know if the timing is different with Vanguard or Charles Schwab or T. Rowe Price. I'm not sure. But all I know is if you buy an index fund and you sell an index fund, you won't see that transaction reflected until after the market closes. They say ETFs are more tax efficient. I'm not sure. I don't see how they're more tax efficient than an index fund, because that's really the only difference. Index funds are passively managed, just like an ETF. The fees, the expense ratios can be just as cheap as an ETF. So the only thing with that is just not quite as liquid, but it's still liquid. Now you just gotta wait till the market closes. So if you're a person who is impatient, I think it might be best, like if you don't feel like waiting until after the market closes to see that index fund transaction updated in your account, then an ETF is best. But if you want to work on that patience, grow your patience, then try index funds. They're just as good as beneficial as ETFs. Now, mutual funds, on the other hand, they came out first. These are like the granddaddy of the funds. They've been around. They're the OGs. But they're not, I don't think they're as popular with the younger generation, people around my age group in their 30s or younger, because one, they're costlier. They're more expensive. So with the expense ratios, with the mutual funds, you're going to pay a lot more with these as opposed to ETFs and index funds, because you have somebody managing it for you. You have a professional stock picker overseeing this entire fund. And let me tell you, from personal experience, picking stocks is a hard job. It is very tedious. You're looking at numbers all day. I tried picking stocks myself. I invested in a few stocks, companies that I know, that I shopped at a long time, and that I think has a competitive advantage. But picking stocks, that is a tough job. It's a tedious job. It's mentally draining. It takes a lot of work. You're looking at balance sheets. You're analyzing balance sheets, income statements, all types of stuff. You're looking at numbers all day. And this is just not for a handful of stocks. This can be for a few hundred to 1,000 stocks. So, I mean, these people got to get paid. They're not working for free. So that's why with a mutual fund, the biggest difference is that a mutual fund is actively managed. You got somebody overseeing the trading, the turnover of each stock that's in that fund. You got, a lot of times you have a chief stock picker, and then you have other people who works on their behalf below them. So it's like a team, and everybody on that team has to get paid for making sure that fund grows. So with mutual funds, they can be great. You have some that outperform the stock market overall, but for the most part, a lot of them underperform the stock market. And you don't want to be paying these high fees for something that underperforms the market, especially when you have ETFs and index funds like growth funds, for example, and momentum ETFs that can outperform the market virtually for free. So with mutual funds, they're out of favor, out of style with the younger generation, man. Especially for the budget-friendly people, you know what I'm saying? We just gonna set it and forget it. Let the fund manage itself. That's another way to kind of separate or discern the difference between an ETF, an index fund versus a mutual fund. With the index and ETFs, the fund manages itself. They just track an index and they go from there. Your money on autopilot, and it's growing on autopilot. And it's a lot of times it performs better than a mutual fund, which doesn't. The mutual fund doesn't manage itself. You got somebody managing it on your behalf. So with that being said, man, I can already tell, you know what I'm saying, we're at the 12-minute mark. I don't want to keep y'all too long. I like to put myself in the viewer's shoes, you know what I'm saying? So I don't want to be looking at a video that's super long, that could have been said in half the time. Hopefully this helped a lot of y'all. I'm going to come back soon, make a part 2. I'm going to have to sit down and kind of make an outline to go off of. I kind of freestyled this because I knew it already, but with the part 2, probably a part 3, definitely won't be going past a part 3. But hopefully that helps somebody. Get a video a like, you know what I mean? Y'all be blessed. Peace.